The market doesn't know what keeps you up at night. It doesn't know when you want to retire, and it doesn't know how old you are. The simple truth is, the market doesn't care. But if you care, you've tuned into the right place. You're listening to Investor Resources, bringing clarity to the confusing world of finance. Here are your hosts of Investor Resources, Don Creech and Perry Sykes.
I'm Don Creech.
And I'm Perry Sykes, and welcome to the Investor Resources podcast.
Well, surprisingly, with the market, the S&P 500 having hit 42 new all-time highs this year, retail investors generally remain sidelined. Apparently, we need another year of rising market and people still sitting in the bank account before fear of missing out, or otherwise known as FOMO, takes over, and retail investors and their financial advisors, who basically just take directions from their clients.
Sure.
But investing, after all, is supposed to be simple. If you read all of the generic stuff and you look at websites, it's just basically diversify and hang on because it'll eventually work out. We just don't know when eventually is. But when it comes down to it, investing is not easy, is it, Perry?
It's not easy at all. And one of the reasons you mentioned it when you started out there, Don, the FOMO, fear of missing out, and the worst part of that is the fear. Fear is such a driving factor in how people invest or do not invest their money at any given time. And this year is a prime example of they're still too afraid to make that move. They don't really believe it. The market's in place, that a bull market is actually occurring, that you can actually make money out there right now, because there are so many negative narratives and there are so many negative things both in the market and outside the market right now, that it's easy to talk yourself out of investing every morning. You could get up and take a look and say, there's just too many chaotic negative things out there. I can't be in this market. And if you would just sit back and look at the numbers of the market, are there things out there making money? Yes, they are. Are there things out there making money in things that I would invest in? Yes, they're there. Why aren't I there? That's all you should be asking yourself. And that's where people get confused, because it's not that complicated. You don't have to have a 200-page manual on how to make every buy and sell in your portfolio. It's way simpler than that, but you do have to be willing to get out of your own way. And a lot of times that's the hardest thing to do.
The problem that people really have to confront is that this is not something that you do sitting back in your recliner and assuming it's all on autopilot. Artificial intelligence has not taken over the investment field, not yet. And it may be some time. As you actually ran the initial test that we did when ChatGPT came out, looking for a formula to decide what to buy and when. And it basically said it's too much chaos. It's not possible.
Not something I can do, it said. Yep.
There are some companies with big budgets that are spending a lot of money trying to do things. There's a firm in England that claims it has created an AI program that is making their bond trading more efficient. Well, that's really a very specific part of investing altogether, and it's the trader's dilemma for execution, which in bond market is a lot more complex than it is in the stock market, because there are a lot more variables we don't think about.
Yep.
So one of which you alluded to is having a discipline. What are your rules? Once you've figured out how you're going to track it, you're a bit closer to how I can enter and exit, because you have established rules in the process.
Correct. And just to clarify that, rules are not turning on cable TV, listening to a talking head, seeing what they're saying to buy and sell today, and then going and doing that. Those aren't rules. That's headline trading. That's trading on emotions. Those guys, the people on television are there for one thing. That's to keep you watching television. The people selling newsletters are there for one thing: keep you reading the newsletter. And they're going to say anything that will do that. that doesn't mean it's a good idea for you to reflect that in your portfolio. In fact, it's usually a terrible way to go about investing. You have to have subjective rules based on things that are important to you. There are different ways to invest. Everybody doesn't have to invest exactly the same way. But the things that are important to you in the market, you have to distill those down to the metrics that will let you know, is cash coming in here? Is cash flowing out of here? Are more people accumulating this stock or selling this stock or this fund? Where's the money going? Where's the popularity in the market? Can I follow that trend? Find what it is that you like to track and then track that. But you have to trust it and you have to do it. That's the discipline part. That's where it's simple but not easy. It's not always easy to say, everyone's saying don't do this, but all the numbers I can find say that's what I should be doing. Who are you going to believe? The people that are talking, trying to sell soap on TV, or the numbers for whatever investing discipline you're following? You've got to be willing to follow your discipline, or you've got no rules.
Well, one of the decisions that you have to make before you establish the discipline is what kind of trader are you?
Oh yeah,
Let's start with the most active trader. That's the day trader. And there's
yep,
two types. There are the traders who are trading intraday. They come in for a couple of hours, they're watching it, they're sitting in front of their computer and they're watching the minute by minute movement of a particular issue and they're trying to get in and get out with a profit. That's a very difficult task, requires some training. There's another day trader that looks at the market during lunch hour, decides what he's going to follow up on when he gets home, does his research at night, then places a trade for the next morning at the open, which
right.
is pretty risky in itself to place a trade and not know exactly what it's going to open at.
Yep,
And then you have other categories. If you have swing traders who are in there for a few days to a few weeks, you have position traders who are building long-term hold portfolios, and among them, you have value investors like Warren Buffett, whose holding period is over the decades,
correct.
who's wealthy enough that when the market tanks 50%, it doesn't change his lifestyle.
Doesn't matter one
And
bit, right?
and you have the growth investors who switch into artificial intelligence or growth in, maybe it's energy that's growing this particular year. Actually, in the 70s, growth was the biggest return provider with oil at the top of the S&P. But that's not where it is today. So you
Right.
have to make those decisions. If you don't want to make those decisions, many people go to a financial advisor for help because they presumably have been trained to help you make that decision in a more disciplined process.
Right.
However, having having been active in financial planning and technically still classified as financial planners, we are registered investment advisors that no longer do financial planning. The process of financial planning is a sophisticated marketing routine. Now, it's not that financial plans won't answer questions for you regarding your anticipated expenses later in life. However, the way the industry works is you answer a questionnaire provided by the financial advisor. And when you get done with those 10 to 20 questions, each answer has a numeric value based on how you answer it. He has a scorecard. You may not see it. I mean, I used to show our clients our
Sure.
scorecard.
You
Here's your
show them
answers.
everything. Sure.
This is the numeric value. We add those values up, and this is the kind of portfolio that academics say is suitable for you. Now, it has nothing to do with what's going on in the market. It does have everything to do with you telling the financial advisor by your answers how he's to position your portfolio until you change your mind. And when you change your mind and change your answers, he will then change your portfolio.
And that's
That
standard. That's
that's that's
standard
the
practice. Yep.
that's the business model.
That's the business model. We used to have the questionnaire ourselves. We used to hand it to clients, and the more we did it, the more you come to the realization they're paying us to tell them how to invest their funds, and we're asking them, how should I invest your funds? And then just doing what they say. So why are we getting paid again? What are we, why should they be paying us for this quote service when they're the ones making all the decisions? Which is when we decided the way you approach the market has got nothing to do with your feelings about the market. And that's all those risk return questionnaires are. What scares you? What are you afraid of happening? And let's try to avoid that if we can. Probably can't, but we're going to pretend we can. And then outside of that, you're going to go into a generic middle of the road 60-40, 60% stocks, 40% bonds portfolio. And we're going to pretend that that's the greatest place for you to be, regardless of what's going on in the market. Fact of the matter is, markets change a great deal, more than ever, and they change more quickly than ever. And sometimes you need 40% bonds. That could be a very good place. The bond market could be doing very well. The bond market could also be a disaster and nowhere you want to be close to. And there's no such thing as, well, bonds are always there for stability and safety. Let's just buy bonds. And in fact, the older you get, let's own more and more bonds, regardless of what the condition of the bond market is. That doesn't make any sense. You have
Let's
to look
stop
at the
right there. Wait,
market.
let me interject right there because we have
Bingo.
recent history with that specific problem. As you get older, the models automatically start putting you in more and more bonds. But the last 4 years, we have been through a bond bear market where
Ah,
bonds have been a worse place to be than in stocks. And we have just in the last couple of weeks actually had year-to-date bond returns for the Barclays Aggregate Bond Index, AGG, turn positive for the first time in 4 years. But the older you are, the more you're going to be allocated into what is supposed to be a safe investment, which
right.
over 40 or 50 years, well, let's say over 40 years, since the 1980s, because prior to the 1980s, bonds weren't as stable as they have been since interest rates
That's
started falling.
right.
And it's that bond bull market with interest rates falling for 40 years that has led to the assumption that bonds are safe. But as inflation rises and credit falls and the economy weakens, bonds have a substantial amount of risk in them that people and financial advisors generally do not want to recognize. So if you're being told bonds are going to be the safety factor in your portfolio, think about cash. You know, cash is cash, and in a falling market, cash still is king.
Yep. And it's not going to be devalued. You're going to hold value there. That's a great place to find some stability because you take away the market influence at all, especially in the short term. And that's all we're looking for. When we have a portfolio that ends up with a substantial cash position, um, we're never intending to stay there. That's true of all the positions in our portfolios. That's part of the discipline we have is we're going to be where we can get the best return with the least risk possible while investing. And at some point, it's like stocks are no good, bonds are no good. Let's don't just load up on bonds and hope it works out okay. Let's just go to cash. Let's put some cash in the portfolio, remove the market risk, and then wait and see what uncovers because something's going to pop up. It always does. Worldwide, something's going to recover. Stocks are going to recover. Bonds are going to recover. Currencies are going to recover. Precious metals are going to recover. Something is going to come up, but you have to be looking for what that is instead of saying, well, I own 40% bonds no matter what. That's not a great way to run a portfolio unless you're a financial advisor looking for the easiest thing to do. Now your job is to stay on the phone and keep people convinced. Well, over the long run, this is a great place to be, which might be true. It's just that your investment horizon is not the same as theirs. You don't have 50 years or 100 years for things to work out. You're retired today. And that's why you need to be looking at what's currently going on in the market and react to that. Are things good or bad? Are risks really, really high or significantly lower? Those things change all the time, and your portfolio needs to reflect those. It's just a matter of doing the work and looking at those metrics, and then, which is actually the simple part, But it's not easy always to make the move that's necessary to make the buy or the sell that can keep your portfolio in sync with the market and out of the worst of the risk in the market, which is even more important. It's easy if markets are going up. It's hard when markets are going down, and it's tough to find a place to hide. That's when you really have to trust your system and follow through with a disciplined process that you're able to say, I'm not comfortable with this right now, but I trust the process and let it work. And that gives you the best probability of being on the right side of those trades.
And so one of the ways you do that is because you're paying attention is rotation from one asset to another. And that may be
Sure.
at times it's from one country to another. It may be broad diversification in EFA, which is Europe, Asia, and the Far East, or maybe more focused on emerging markets, or maybe focused on a particular country that's doing very well. But it's willingness to move outside of the standard box and say, I'm just going to buy this stuff. I'm going to buy a bunch of everything, and I don't really know a lot about it, and just hang on to it because something's bound to work. And Paul, we kind of make light of that. That's really the core foundation to the modern portfolio theory. And you
It
have to
is.
recognize this is out of the box again. Is academic studies have nothing to do with the amount of money you have to invest or the time frame in which you are investing and expect to need the money. And
Correct.
stuff happens in life where your Apple Card is upset. COVID upset a lot of companies' businesses. And we have
Yep.
clients with businesses, and they find themselves struggling with the resurrection of the business and loss of clients afterwards. How do you stay in business? And you need those resources. And the academic study that says you should just stay invested forever and not use your money does not apply to a household. Think
Not at
about it.
all. It never will apply to a household. It's not the same. And we need to wrap this up, Don. But just keep in mind, if you're going to let someone invest your money, go talk to somebody who's looking at the market to get the data for what's going on and not asking you for your opinion about what's going on. It's the difference is night and day. Huge advantage to your portfolio.
Well, that's consistent with our portfolio process. We focus
Yeah,
first on the market, and then we respond to the clients when they don't quite understand why we're doing something. We can show them what the market's telling us, and that's why it's in their portfolio. It's not
there
because
you
of
go.
a personal opinion. Anyway, subscribe to the podcast. You'll get updated when we do our next one. And go to our website, iriradio.com, and register for the stock market updates that we do on the first Saturday of every month. Thanks for being with us. Look forward to the next time. Have a great day.